Fundstrat Global Advisors Tom Lee joins us with his predictions. Tom, it's great to have you back. I imagine you were listening just now, and I wonder if you take these sort of disparate signals out of earnings so far, and is that just characteristic of a period in which the job market may be in transition?
I think that's right, Carl. I know investors are wrestling with a lot of questions in their minds because inflation is higher than they expected at the start of this year, and rates are higher, and stocks are higher. So they're wondering if this is a payback period. And now we're hearing different forecasts for Fed cuts. And as you're pointing out, I think it's been an overall good earnings season, but we're hearing evidence of companies not being able to pass on price, and there's some demand weakness and wage pressures. I think that's part of the confusion that's taking place now. But to me, I'm kind of in the camp that despite all this, it's all going to come down to whether inflation improves in the next couple of months or the rest of the year. And if it does, a lot of these sort of clouds lift, and I think markets actually do quite well.
Which is why I think the consumer weakness commentary and the weakness that Chair Powell cited in terms of demand for labor, at least weakening back to pre-pandemic levels, is important, right, Tom? Shouldn't that ultimately bring inflation levels down?
That's right. I mean, I'd say the interview that CNBC did with Starbucks yesterday was very telling. I think that the answer ultimately there is they probably have to cut price, and if they're cutting prices, that's not reflation anymore. It's a reversal of that. And I think we're seeing consumers basically have their wallet getting squeezed because auto insurance and homeowners insurance has really sort of eaten in their discretionary dollars. And again, that's not really an inflationary signal. So I think the bar is actually being lowered now for the Fed to cut. And I think that's something I think many people picked up. I mean, the Fed stated it clearly. If the employment market even shows signs of weakness, that's another reason to cut rates. And we'll find out tomorrow.
Well, yeah, we're looking forward to seeing what the job market tells us, Tom. So then, does the playbook short term look like mega cap, or are you in the broadening camp and want to play in the other 493?
Well, yesterday was a good day for market breadth. That's why small caps rallied despite the S&P and NASDAQ being down. And, it really comes down to what interest rates do. I think that there's still a good probability rates are peaking now. And if interest rates are lower because we either get softer jobs or inflation weakens, that's a more 493 signal and obviously much better backdrop for small caps. So that would be sort of what we think leads in the second half. But I still like the technology story just because of all the drivers behind AI.
Although quite a reaction that we're getting on earnings. I think I read in a Goldman note, it's like almost, it's at least 3.5 times the normal reaction to that stocks are having to earnings than they usually get off earnings season, which, I don't know, what does that tell us, Tom, that the market was rich going in?
I mean, it could be the market was rich, or the market is really grappling with trying to understand what the real narrative is between now and the end of the year. Because, on the one hand, if inflation's accelerating, then we would have a very different playbook in our head. And if demand is faltering, or if things are just fine, and that's why companies who are beating are doing really well. So I think that's the confusion. But, at the end of the day, I think as much as it feels bad because April was a down month, I still think probabilities favor May being an up month, and of course that the market does well the rest of the year.
Ladies and gentlemen, stocks did well today. By well, I mean the NASDAQ up 1.2%, the Russell up almost 2% today. Now, don't get too lost in the sauce here, because tomorrow you're going to have some very big data coming out that will cause a large reaction in our markets. I do have a little bit of good news, because I think that data is going to come in better than expected. Maybe worse than expected, which could be better than expected for the markets. And we'll talk about that here in this video. We do have Apple earnings that will be coming out momentarily. And considering Apple doesn't tend to move much on earnings, I think Apple could actually be priced for an upside move following their earnings. So let's go ahead and get into all of this information. We will go over the state of our markets and give you a technical overview on the NASDAQ and my, again, expectations for tomorrow. So first things first, markets did well today because yesterday was a bit of a shit show. Okay, let's just be honest. The markets reacted appropriately to the Fed. At first, the Fed was very dovish. They threw away any and all hopes the bears had towards rate hikes. You're going to have to see inflation expectations on the longer term rising, inflation rising, the economy doing red hot or still doing very well in order to get a rate hike. It doesn't look like that combo is going to be coming for our markets, our economy, anytime soon. So it looks like we're far off of a rate hike. So those fears were alleviated. The Fed actually gave you good news that said, hey, instead of reducing the pace of our holdings of treasuries by 30 billion a month, we're going to go to 25 billion a month. They were previously at 60 billion. So that was better than expected. That means less selling pressure in bonds, less upside pressure on yields. So those were really kind of the two main things out of yesterday's Fed meeting. But overall, the Fed just pounding home that dovish stance. The Fed basically said, if inflation continues sideways, we can just hold rates where they are for longer, that it's maybe going to take longer to get inflation down. The lags are going to take longer. And Fed Jerome Powell even went out to say that he believes the renting disinflation we have seen in the actual real economy will be reflected in the data at some point down the line. So all of that was fantastic news. No wonder small caps are outperforming. The question now is, how strong is the economy going to be, for how long, and when does the Fed get a reason to start cutting rates? I noticed that the Fed kept going back to the unexpected weakness scenario in the labor market or the economy. Now, keep in mind the Fed, before Fed meetings, let's say if inflation comes out a day or two after the Fed meeting, if the Fed is having that meeting 2 days before inflation comes out, odds are the Fed already knows what those numbers are going to be. Same with non-farm, same with the unemployment rate, blah, blah, blah. Okay. So tomorrow you're going to have some very big data. The Fed likely already knew what that data was going to be. And I believe that's why they were a little bit more on the dovish side. You are expecting tomorrow morning, 8:30 in the morning, non-farm payrolls are going to come in at 238,000. Estimates are anywhere from 245,000 to 230,000, anywhere in that range. Now, I think that's a pretty high expectation. I think that's a pretty, high expectation for non-farms. Now, here's the deal. If non-farms come in higher than this, if they come in at, let's say, 300,000 like they did last month, well, that's not necessarily a bad thing either, as long as inflation doesn't continue to go higher. Because again, the Fed's not going to hike rates just because the economy is doing well. And theoretically, as long as people are working and getting jobs, that means people can spend, and that means company earnings are likely to come in good. So that is, I guess, your more bearish way of looking at it. And it would be a toss-up maybe how the markets ultimately look at that if we did have a big beat to non-farm payrolls again. But it wouldn't surprise me if stocks rallied off of that, because again, that would mean company earnings are probably going to continue to come in well for all of 2024, or at least right now. If you come in lower, let's say 200,000 job ads, that's fantastic. That is showing that the economy is not running red hot. So one of those criterias to get rate hikes would kind of go on the back burner. Again, criterias to get another rate hike would be the labor market continuing to be strong, economy in that sense continuing to be strong as well, inflation continuing to rise, and expectations for inflation rising as well. If the economy's not running red hot, labor market's not running red hot, then your chances of getting another rate hike, even if inflation continues sideways at this, 3.6% run rate for core PCE, are very, very low. So a number around 200,000 would be good news. A number anywhere from 150 to 200 would likely be seen as good news by the markets. Here's the catch though. If you come in lower than 150,000 job ads, like 130,000, which would be a huge miss based on 240,000 as the expectation is right now, then that would be seen as bad news. That maybe the labor market's starting to weaken in a big way. Maybe people are starting to lose their jobs. And if that happens, well, that puts company earnings under pressure. And then the bad part is the Fed's really not going to be prompted to cut rates on one non-farm payroll report, right? They're going to want to see inflation continuing to fall unless you were to come in like negative on your non-farms, which I don't think the Fed indicated anything like that was going to happen coming tomorrow. But they were pretty dang dovish nonetheless. Now, the unemployment rate is also going to come out tomorrow morning at 8:30 in the morning, expecting about 3.8%. Now, a number around 4 may be seen as a little bit of bad news. Again, you can make an argument, that's why it's so weird where we are right now in this, economy cycle, where really good data could be seen as good. And you could make an argument that that is really good. Really bad data, you can make an argument that that is good, but also bad at the same time. So there's really 2 outcomes for any of the data tomorrow that could be good or it could be bad, even if the data comes in really good or really bad. So it's kind of weird. But again, you are expecting 3.8%. Anything higher than 4% would probably be seen as a negative. If you were to come in at like 4.2%, that would not be seen as a positive, in my personal opinion. If you come in lower than 3.8%, I think that's going to be seen as a positive. Now, at the same time, 8:30 in the morning tomorrow, Eastern Standard Time, you're going to get the average hourly earnings month over month and year over year. That's going to be important as well, expecting 0.3% on the month over month and year over year at 4.1%. Participation ratio, average weekly hours, government payrolls, manufacturing payrolls, and non-farm private payrolls. You will also get the U6 unemployment rate, as well as S&P Global Composite PMI final numbers for April that will be coming out at about 9:45 in the morning, so right after markets open. And then at 10 a.m. in the morning, you're going to get ISM Services PMI. And I think this is why tomorrow will be big. Let's say theoretically non-farms come in lower than expected, unemployment rate rises, and you get an ISM Services PMI that also falls. That's going to be seen as really good freaking news. You want some really good freaking news, huh? You want really good news? You want really good news? Yeah, he does. And ISM Services PMI is expected to come in at about 51.8. Last month was 51.4. So you are expecting this to actually rise. Last month, ISM Services PMI came in well lower than expectations. So another fall would be good. Now, anything under 50 is considered contractionary. So if you get a number under 50, then that could get a lot of people's optimism rising for, maybe some rate cuts coming sooner than expected. Now, we do have, as I said before, earnings coming as well today here in After Hours. You have Apple, Coinbase, Block, DraftKings, Cloudflare, Bill.com, Fortinet, Amgen, Booking Holdings, and Expedia. You have some other stocks as well that are, smaller names, not as well coveraged by analysts. Apple's obviously the big one. Apple is number 1 or number 2 still for the market weighting in the NASDAQ and the S&P. So if Apple rises or falls, that's going to have a big effect on our markets. And I will tell you right now, I think Apple's probably going to rise. Why is that? Okay, and it's actually pretty simple. Apple has fallen a lot in 2024. When you started 2024, Apple went down 3.5% literally the first trading day of 2024, but you started the year at about $194 per share. You are currently down in 2024, about 11% from the high. Now, if you consider that 3.5% drop, which most people do, to be the start of that, then you're only down about 8% or so. But you're really down like 11% to start 2024. I think Apple's numbers are going to be bad. I think Apple's not going to have fantastic things to say, but I think margins are going to hold up. And I think Apple is one of those unique companies that only comes around every now and again, where even with bad numbers, they have a way of sugarcoating things to make things sound better or not as bad as they actually are. So Apple can spin a report to seem more positive than it is. Now, again, with Apple down, let's call it 11% to start 2024, you're already pricing in bad numbers. So things would have to be like really, really bad to be worse from here. Now, you have also had Skyworks and Qualcomm. You've had NXP Semiconductors that have reported. These are all direct suppliers to Apple. So we kind of already have an idea, or I would say a really strong idea of what is going to happen next. Is this M&M flavored lip balm? You like M&Ms, dude? Yeah? Never had an M&M yet in his life. But yeah, so we already kind of have a good understanding of what Apple is going to do. And I think that's why Apple is probably not going to fall that much. If it rises, great. Apple's up 2% today, so I think maybe another 2 to 3% rise could make sense from here. But I don't think Apple's going to fall in any kind of meaningful way to really drag down the markets in any kind of meaningful way. So I think Apple could actually be a positive catalyst for our markets coming tomorrow. Now, as I have said before, I think Apple can raise sentiment in the markets, but I don't think it's going to do all too much for the NASDAQ. And why I believe this, and it's not just Apple specifically, but the NASDAQ is already fairly priced. It's already expensive. And the companies on the NASDAQ don't benefit from the Fed raising or really lowering rates, right? Your market cap weighting in the NASDAQ, your 45% weighting in the NASDAQ, which is your big tech stocks, your Magnificent Seven stocks. They control about 40 to 45% of the NASDAQ itself. And they have by far the largest weightings. I'm thinking Microsoft, Apple, Google, Amazon, Nvidia, Tesla even, right? Besides Tesla, these stocks really don't benefit from the Fed cutting rates. A company doesn't decide to get Microsoft Cloud products if the Fed raises or lowers rates. Companies really don't decide to advertise more or less on Google or Meta, depending on what the Fed is doing with their interest rate policy. Those companies benefit by far more when rates stay higher for longer because they get to, put their $30 to $200 billion of cash on their books into short-term treasuries and collect a lot of interest that is basically just free profits and boost EPS. So believe it or not, if you do get good data tomorrow and non-farms come in light, let's say the unemployment rate comes in a little bit higher, but let's say ISM services come in weak, in which that's kind of my overall expectation. The small caps would be the ones to really benefit from that. And that's why these small caps are outperforming today. Look at that. Russell 2000 is up 1.8%. And I believe if the Russell can get above $200, then you could get a larger rally up to about 208. And it wouldn't surprise me to see a big day tomorrow if I am correct, given the backdrop of what the Fed has just outlined, right? And we've went over that a lot here in this video, so I'm not going to rehash all of that. But the Fed was very bullish yesterday. As long as you get the data coming through with that, I think the Russell has a long way to go to the upside. And I think in the short term, that could mean some pretty large gains. Like, it wouldn't surprise me if the Russell was up 3 to 4% tomorrow if non-farms come in weak, if the unemployment rate rises slightly, and ISM services PMI comes in lower than expected. So that's the area that I'm specifically looking at that I am excited about. The NASDAQ, sure, could you go up? Of course, but I don't think you're going to break out to new all-time highs, which call it around 450. I think it's somewhat limited here, but yes, there still could be a trade in the NASDAQ. Don't get me wrong. To get back to all-time highs, your previous all-time highs, that would still be a gain of over 5% from here. So there can still be some money to be made in the NASDAQ, don't get me wrong. But I think if things go the way that I'm expecting, I mean, for IWM, for the small caps to get back to, let's call it, all-time highs, you're probably going to have to start really getting close to some rate cuts from the Fed. So we'll see what happens. But you'd still be looking at upside of almost 20% from here. So I think the move could be outsized for the IWM. To the upside or the downside tomorrow. Let's be honest. I think that's where it makes sense to be positioned in. But again, I don't have a crystal ball, and let me know what you think about that down below in the comment section. Current fear and greed indicators for the fear and greed indicator on CNN is sitting at fearful at 36. Yesterday, you were at 40. So even despite this rally that you're seeing in the markets today, people are pretty fearful still around Apple earnings and around the data coming out tomorrow. Now, the sentiment data over here on the AI sentiment survey. The bulls are now in control as of yesterday, May 1st. 38.5% of investors are bullish, 29.0% of investors are neutral, and 32.5% of investors are bearish. So the bulls are back in control, but it's still pretty even here with bears and bulls, which historically speaking, the historical average is around 37.5% bulls, 31.5% neutral, and 31% bears. So you're almost in line with historical averages. The bears could afford to go up a little bit, the bulls could drop a little bit, and neutral investors could also go up as well. Just again, something to think about. Now, if you look at the percent of stocks above their 50-day moving average today, you're up okay, let me put it like this. 5.5% of stocks out on the markets today are breaking above their 50-day moving average. That is a very strong move for the average stock. So that's going to go ahead and do it for this video. That's really the core of what you need to know heading into tomorrow. Hit the like button as well as subscribe to the channel. You guys have a great rest of your day, and I will see you in the next one.